Okay, you want to kind of be able to predict where fixed rates are going. Well, you have to understand the relationship between bond yields and fixed rate mortgages. Now, a bank buys a bond as a lower cost source of interest income in comparison to a fixed rate mortgage they offer their clients, which is a higher cost to them. It costs more to operate or manage that loan. Now, fixed rate mortgages and bonds operate on similar terms, so 2-year, 3-year, 5-year terms. And the bank then uses that low cost source of interest income, the bond, as kind of a benchmark to determine what they should charge for the more costly fixed term mortgage that they offer clients. Now, in a normal market, the spread or the markup between the bond yield and a fixed rate mortgage is about 1 to 2% or 100 to 200 basis points. So if bonds were yielding 4%, you could expect that the fixed rate mortgages would be probably around 5 to 6%. Now, here's where it gets a little bit more complicated. Interest rates always change. So in order to ensure that bonds are not rendered worthless, because why would a bank want a bond at 4% when they could get one that's 5%? Bonds are traded on the public market at higher or lower than their original face value in order to equalize the yields or the returns. Now, that continual or constant exchange on the market is what determines the yield of bonds based on their length of terms. Here's an example. If an original 5-year bond was issued at $1,000 with a $50 coupon or a 5% annual return, now if that bond was sold at $1,100, right, the yield would now change. $50 divided by 1,100 would yield 4.55% interest. Or on the flip side, if it was now $900 for that same bond, and that $50 coupon obviously is still offered, the interest or the yield has increased to 5.5% versus the original 5%. So when bond prices go up, yields come down and vice versa. As bonds become less or more attractive, the price at which they're bought or sold at changes, which affects the interest or the yield. So if you kind of want to predict where fixed rates are going, watch the bond prices. The spread's about 1 to 2%. Also look for whether or not they're kind of on the rise or on the decline to determine whether or not fixed rates are rising or declining.